Welcome to Market Insights, informed news and analysis powered by TradeStation. Today is Monday, March 12th, and I'm David Russell. Today, Goldilocks, call your office. It doesn't get much better than this, or at least it hasn't been this good in a long time. We're talking about the economic numbers and what it could mean going forward. Unemployment and inflation are both really low. To put that in context, let's use an indicator created during the bad times of the 1970s, the misery index. It's the unemployment rate plus the consumer price index. So high readings are bad and low readings are good. Back in the 1970s and early 1980s, it mostly stayed over 10 and occasionally hit 20. These days, it's nowhere near those levels. In fact, the misery index has been sitting around 5.8 for the last several months, the least miserable since 1965. Speaking of the 1960s, jobless claims recently hit their lowest level since 1969. That's the number of people seeking unemployment benefits from various state governments. Another positive. While many numbers have been strong, we've mostly lacked big blowout growth ever since the 2008 financial crisis. For instance, back in the late 1990s, there were literally dozens of months with at least 300,000 jobs added. This decade, it's only happened 10 times. But, and this is a big but, last Friday's non-farms payrolls report was huge. 313,000 jobs added, way above estimates. Plus, the previous 2 months were revised up by 54,000. Could things remain this strong? Let's consider some potential catalysts. First, manufacturing has been on an upswing. 31,000 of those jobs were added last month. If you add a running 3-month average to smooth our short-term changes, it shows that we're running at a pace last seen in 1998. Remember that factories have positive knock-on effects for other businesses like warehouses and transportation. By the way, speaking of transportation, as a side note, did you know that U.S. railroad traffic is running at its strongest clip in at least 4 years? This is often viewed as a forward-looking indicator of business. Second, construction. 61,000 additional workers picked up hammers, saws, and building materials last month, the biggest gain in almost 11 years. Then, consider America's well-known lack of affordable homes. Plus, housing starts are still very modest based on historic norms. So it's not too crazy to see the potential for more growth in construction either. All those points are based on sheer raw statistics, but there's also some anecdotal evidence. Companies like Target and Ross Stores this earnings season talked about having no choice but to give workers raises. Next, don't forget about Bank of America and Chipotle and Wells Fargo and Walmart, all companies that talked about hiking pay or adding employees thanks to last year's tax cut. Also Home Depot, Starbucks, Comcast, Disney, CVS, Honeywell, to name a few. Once again, it's not outrageous to expect multiplier effects from all this money going into Americans' pockets. Will strong employment help people buy houses at higher prices? Will that make builders more confident to hire? Will banks, flush with capitals and with the subprime crisis well in the rearview mirror, grease the wheels with more loans? Could all of that in turn feed more confidence? Now, don't get too giddy or think this is a recommendation to get careless. Far from it. After all, that mini crash last month shows how complacency can kill. But also, traders might want to remember that there were real reasons why the market felt so positive. And if anything, those reasons not only remain, but could be even increasing. That's today's Market Insight. Be sure to visit our newsfeed at tradestation.com/marketinsights for more.